All right, let's jump right in, shall we? Today, we're taking a deep dive into Warren Buffett's 1995 letter to Berkshire Hathaway shareholders. I know you guys love getting to the good stuff quickly, and this letter, well, it's packed with insights.
It really is a fascinating snapshot of the market and Buffett's thinking at a very interesting time.
Exactly. We're talking about a year when Berkshire's net worth shot up by like a crazy 45%. And even Buffett himself said that, and I quote, any fool could have made money in the stock market that year. So that got me thinking, if it was so easy, what's the real lesson here? What can we learn from a year that almost seems, I don't know, too good to be true?
That's a great question, and I think 1995 really shows us how deceptive market conditions can be. A rising tide might lift all boats, but that doesn't mean every boat is actually seaworthy.
Okay, so it's not just about riding the wave. It's about finding the businesses that can handle any storm.
Mm.
Gotcha. And speaking of solid businesses, Berkshire made three pretty major acquisitions in 95, Hillsberg's Diamonds, R.C. Willey Home Furnishings, and of course the big one that everyone always talks about, Gigesso. What stood out to you about these deals?
Well, one thing that's clear is that Buffett wasn't just chasing growth for the sake of growth. He was looking for companies that, well, kind of like well-built castles, strong, defensible. He often talks about businesses with economic moats, things that give them an edge, that make them hard to compete with. And in these acquisitions, you really see him zeroing in on a few key things: strong management teams, consistent profits, unique advantages.
So, like, don't just buy a house, buy a fortress. And that makes me think of that line from the letter where he says, buying a retailer without good management is like buying the Eiffel Tower, but without an elevator.
Exactly. The people running the show, they matter just as much, if not more, than the business itself. Buffett's always said he likes to bet on the jockey as much as the horse.
Love that analogy. Makes total sense. And, speaking of Geico, it's, well, kind of like a love story for Buffett, right? I mean, showing up at their doorstep as a student, that's classic Buffett.
It really is.
He even calls it his first business love. And even though he, well, kind of made a $1 million mistake by selling his shares way back when, he eventually got a second chance.
And that actually brings up a really important point. Even the greatest investors, they make mistakes. What matters is learning from those missteps. And Buffett, well, he's never been afraid to admit when he's wrong, which is something we could all learn from.
For sure. Okay, so let's talk about something that kind of jumped out at me. Buffett seems pretty skeptical about relying on financial projections, even going so far as to compare it to selling a limping horse when it's walking just fine. What's the thinking there?
It's all about not being fooled by, the hype, the fancy forecasts. Sellers, well, they're always going to present the rosiest picture possible, right? But as a buyer, you have to look deeper, beyond the hype.
So, like, do your due diligence.
Yeah.
Be a detective.
Exactly. Understand the fundamentals. Does this business have a genuine competitive advantage? Is the management team solid? Those are the questions that really matter.
That makes sense. Okay, so Berkshire has kind of a unique advantage when it comes to making acquisitions, don't they?
Yeah.
They often use their own stock as payment, which got to be pretty appealing for a lot of sellers.
Oh, absolutely. It's like offering a piece of a dynasty, especially for, say, a family-owned business. Berkshire's stability, their long-term focus, and their hands-off approach, it's like a safe haven for their legacy. They're not just cashing out, they're joining a team.
Makes sense. Okay, so there's this really interesting part where Buffett talks about have to be smart every day versus have to be smart once businesses. He uses retailing versus owning a TV station as an example. And it made me wonder, how can we, like us regular investors, use this to make smarter decisions?
It's about understanding the nature of the business, right? Some businesses, they're like a trendy clothing store, always needing to adapt to be on top of the latest trends. They're constantly innovating just to stay ahead of the game. Others, they're more like, that reliable TV station in a small town.
Yeah.
Their advantage is, well, it's more built in, more stable.
Okay, so it's like understanding the business terrain. Is it constantly changing, or is it more of a solid foundation? That helps us figure out what kind of smarts, how much we need to win in that particular arena.
Exactly. And that actually brings us to one of the most powerful concepts in Buffett's playbook, float.
All right, hit me with it. What is float, and why does it matter so much?
Imagine you're running an insurance company. You collect premiums up front, right? But you don't pay out on those claims until later, sometimes much later. That money you're holding on to in the meantime, that's the float. And while it's like free money you can invest in other businesses and other securities while you're waiting,
Wait, so it's like having this giant pool of money that's constantly being replenished, and you get to use it to make even more money.
Pretty much. And Berkshire. Well, they've been amazing at getting float at incredibly low cost, sometimes even negative cost. It's like free equity, and it supercharges their returns.
So it's like a secret weapon.
You could say that.
Okay, but even with all this success, Buffett does mention some of the risks that come with insurance, especially with supercat events like hurricanes, earthquakes, things like that. These events can cause huge losses.
That's true. They can be unpredictable and, well, pretty devastating. But here's the key thing about Buffett. He's comfortable with some short-term volatility if it means better earnings in the long run. He has a long-term vision and a strong stomach, you could say.
So it's about being prepared for rough seas, but having a sturdy ship and a clear destination.
Exactly. You're not going to let a little turbulence throw you off course.
Makes sense. And that kind of leads us to another important takeaway: patience and a long-term perspective. We got to talk about Buffett's personal stock picks, where this philosophy really shines through. He calls his approach the Rip Van Winkle approach, like he's sleeping through all the market ups and downs.
I love that analogy. He's not chasing after those quick wins. He's finding businesses he can hold on to for years, maybe even decades.
And the fact that 5 of Berkshire's top 6 stock holdings were the same as the year before, well, that speaks volumes, doesn't it? He believes in the power of holding on.
It's definitely a contrast to all the frantic buying and selling you see so much these days.
For sure. Okay, so remember that story about Buffett buying Disney stock back in 1966? He bought it at a great price, but then sold it just a year later and missed out on those massive gains. Even the Oracle of Omaha, he makes mistakes.
It just goes to show you, even the best of us can get caught up in short-term thinking sometimes.
Absolutely. Okay, so we've talked about acquisitions, his Rip Van Winkle approach to stocks. Now, I want to get into this part of the letter where Buffett actually admits to a pretty big mistake: his investment in convertible preferred stocks. He specifically talks about the Gillette purchase and how choosing preferred shares over common stock cost Berkshire millions.
This part is really fascinating because it shows that even when you're bullish on a company, the structure of your investment, it matters.
So, like, the devil's in the details.
Exactly. Sometimes the so-called safer option ends up costing you more in the long run. It's a great reminder to really understand how different investment structures work and the opportunity cost of playing it too safe.
So it's like choosing your path up a mountain. The easier route might lead to a dead end.
Exactly. And in the case of Gillette, Buffett realized that his desire for that sure thing with the preferred shares, well, it actually caused him to miss out on the huge growth potential of the common stock.
So even when you're right about a company, how you invest in it makes a difference.
Absolutely. And that leads us to another bold move by Buffett, his decision to recapitalize Berkshire to create Class B shares. And those shares, they were valued at just 1/30th the value of the Class A shares.
Okay, so he's shaking things up. Why split the shares like that?
This move was all about combating these clone funds that were popping up, trying to, well, basically mimic Berkshire's success.
Right. It's like they were trying to sell Buffett in a bottle.
Pretty much, they were offering a watered-down version of Berkshire's approach, but with all these added fees. And Buffett saw that as unfair to investors and a bit of a threat to Berkshire's reputation.
So he basically said, if you want to invest like Berkshire, here's the way to do it directly. No middleman, no crazy fees.
Exactly. By creating those Class B shares, he gave smaller investors a way to participate in Berkshire's success without getting ripped off.
Brilliant. Protecting his shareholders and strengthening the brand in one move shows how much he really cares about his investors.
Absolutely. That commitment to shareholder value is core to Berkshire's culture. But here's where things get really interesting. Even while he's creating these new shares, he issues a warning.
Oh. What's that?
He says that Berkshire's stock has been outperforming the business itself. And this can't last forever. He's basically hinting that there could be a period of underperformance coming.
Wow, that's pretty bold. Why would he say something like that?
He's reminding everyone that trees don't grow to the sky. Markets are cyclical. Periods of huge growth, well, they're often followed by periods of slower growth. It's a lesson for all of us. Past performance, it doesn't guarantee future results.
So, like, enjoy the sunshine, but be prepared for some rain.
Exactly. It's a reality check that can help investors stay grounded and not get too caught up in the hype.
Okay, that makes sense. Okay, so we're back. And I'm still kind of thinking about that warning from Buffett, about Berkshire stock potentially underperforming. It really makes you stop and think, like, things can change, right? What worked in the past, well, it might not work forever. Makes you wonder, what signs should we be looking for to see if a stock is getting ahead of itself?
That's the million-dollar question, isn't it? The one every investor should be asking. And one thing that Buffett's always emphasizing is, well, this difference between price and value. Just because a stock is going up, it doesn't necessarily mean it's actually worth more, right? You got to look at the underlying business, the fundamentals. Is it growing? Are profits increasing? Does it have, a sustainable competitive advantage?
Oh, it's like before you buy a car, you got to check under the hood. A shiny paint job? Well, it doesn't mean the engine is in good shape.
Exactly. And, another key concept here is this idea of market cycles. Buffett's not trying to predict the market's every move, but he gets it. He understands that markets, they go through these periods of, what's the word, exuberance maybe, and fear too. Sometimes prices, well, they get inflated, and sometimes they get, I don't know, irrationally
It's
depressed.
like the tide, right?
Yeah.
Going in and out. You can't control it, but you can learn to ride the waves.
That's a great way to put it. And the key to, navigating those market cycles, well, it's staying disciplined. When everyone's getting greedy and prices are like soaring, it's really tempting to jump in, but that's usually the worst time to buy. And then when everyone's fearful and prices are plummeting, well, that's when those opportunities, they start to pop up.
So it's about being a contrarian,
Yeah.
going against the crowd. But that's easier said than done, isn't it?
It definitely takes courage.
Yeah.
And conviction. But that's where Buffett's focus on intrinsic value, it comes in. If you've done your homework, if you really understand what a business is truly worth, well, you're less likely to be swayed by all market swings. You can buy when others are selling and sell when others are buying.
Okay, that makes sense. But let's shift gears for a second. Go back to that point we touched on earlier about Buffett admitting he made a mistake with that Gillette purchase, specifically choosing those preferred shares over common stock.
Right, right. That's a perfect example of how even the best investors, they can stumble sometimes. It highlights this importance of really understanding these different investment structures and the opportunity cost of being, I don't know, too conservative. Sometimes that seemingly safer option, it can end up costing you more in the long run.
So it's like choosing the wrong trail. You think you're taking the easier path, but it ends up leading you further away from where you want to go.
Exactly. And with Gillette, Buffett realized that, that desire for a sure thing with those preferred shares, well, it made him miss out on that huge growth potential that the common stock had.
It's like a reminder that even when you're right about a company, the way you invest can make a big difference.
Absolutely. And, that brings us to another fascinating thing from this letter, Buffett's decision to create those Class B shares for Berkshire Hathaway. It was a bold move, and it was all about addressing this growing problem, the emergence of all these clone funds.
Right. It's like they were trying to bottle Buffett's his magic and then sell it at a premium.
Exactly. They were offering this watered down version of Berkshire's approach, but with all these hefty fees attached. And Buffett, well, he saw that as, unfair to investors and a threat to Berkshire's to their reputation.
So he kind of took matters into his own hands. Like,
Yeah.
hey, if you want to invest like Berkshire, here's how you do it directly. No middleman, no outrageous fees.
Precisely. By creating those Class B shares at a fraction of the price of the Class A shares, he gave smaller investors a way to participate in Berkshire's success without getting ripped off.
So smart. He protected his shareholders and he strengthened the Berkshire brand all in one move.
Yeah.
It shows how much he really cares about the people who invest in his company.
Absolutely. That commitment to shareholder value, it's a hallmark of Berkshire's culture. But here's where things get really interesting. Even as he's creating this new class of shares, he also issues a warning.
What's that?
He says that Berkshire's stock has been outperforming the actual business, and this can't go on forever. He's basically, he's kind of hinting that there could be a period of underperformance on the horizon.
Wow, that's a pretty big statement to make. Why would he say that? It's almost like he's, I don't know, trying to temper expectations maybe.
He's reminding everyone that, trees don't grow to the sky. Markets are cyclical. Periods of outperformance, they're often followed by periods of underperformance. It's a lesson that applies to all investors. Past performance doesn't guarantee future results.
It's like saying, enjoy the sunshine, but be prepared for a little rain.
Exactly. It's a reality check, right?
Yeah.
And it can help investors stay grounded and not get swept up in all the hype.
Okay, I get it. So we've been talking about market cycles, about strong leadership. Now let's go back to Buffett's Rip Van Winkle approach to investing. You know, that idea of holding on for the long haul. He's famous for saying, our favorite holding period is forever.
It's a philosophy that, well, that really goes against all that short-term thinking you see so much of in the investing world. Buffett's not trying to time the market or make a quick buck. He's buying into businesses he believes in and letting them compound over time.
It's like planting a tree and letting it grow. Knowing that with time and care,
Yeah.
it will, it'll bear fruit, but not all trees grow at the same rate, right?
Right.
Some businesses are, well, they're just naturally faster growers than others.
That's true. And that's why it's important to really understand the dynamics of the industries you're investing in. Some sectors are just, well, they're inherently more volatile than others, and that's okay. What matters is finding businesses that are, well positioned within their industry and have a clear path to long-term growth.
So it's like assessing the business terrain.
Yeah.
Right? Is it a dynamic, ever-changing landscape, or is it more like a solid, unchanging foundation that helps us figure out like what kind of growth to expect and how much patience we need to have?
Exactly. And that brings us back to this idea of economic moats. Those durable competitive advantages that really that protect businesses from their rivals.
Oh yeah, those moats. We touched on them earlier, but I'd love to dig a little deeper. Can you give us some concrete examples of what those moats actually look like in the real world? Like, what should we be looking for when we're analyzing companies?
Sure. Think about a company like Coca-Cola, for example.
Yeah.
What makes them so successful? It's not just their secret recipe, it's their brand recognition, their global distribution network, their deep relationships with retailers. They've built this fortress around their business.
Okay, so it's like they've built a fortress, like we were talking about earlier.
Exactly. And those walls, they make it really hard for competitors to gain a foothold. And then you've got another type of moat, a low-cost production advantage. Think about a company like Walmart. Their massive scale, their efficient operations, well, allows them to offer lower prices than their rivals.
So they can undercut the competition and still make a profit.
Exactly. And then there are companies like Google or Facebook. They benefit from these network effects. The more users they have, the more valuable their platforms become, and that makes it much harder for new players to even compete.
It's like a snowball rolling downhill,
Yeah.
right? Getting bigger and faster as it goes.
Precisely. And then finally, you've got companies that rely on intellectual property, like patents or trademarks, to protect their businesses.
Yeah.
Think of pharmaceutical companies with those blockbuster drugs, or software companies with unique algorithms.
So when we're analyzing companies, we need to be asking, what are the moats protecting this business? What makes it special? What makes it hard to copy?
Exactly. And remember, the best moats are those that are wide, deep, and durable. They provide lasting protection, and they allow those companies to generate consistent profits over time.
All right, moats checked. Now let's switch gears a bit and talk about another theme that runs through all of Buffett's letters: capital allocation.
Right, capital allocation. It's essentially the process of deciding how to use a company's resources to generate the highest returns. It's a crucial skill for any CEO, and Buffett is widely considered, well, a master of it.
So it's like being a chess player, maybe.
Yeah.
Strategically moving your pieces to gain an advantage.
That's a great analogy. And Buffett's main goal, well, it's to find opportunities to invest in businesses with high returns on capital. He wants to put his money where it will grow the fastest and create the most value.
That makes sense. He's not looking for just any investment. He's looking for the best investment.
Exactly. And he's incredibly disciplined in his approach. He's not afraid to walk away from deals that don't meet his criteria, even if they seem tempting on the surface.
So it's about being patient, about waiting for the right pitch to swing at.
Exactly. And then when he does find an attractive opportunity, well, he's willing to make big bets. He understands that concentrated positions and his best ideas, they can lead to outsized returns.
It's like putting all your chips on the best hand in poker.
Precisely. And that brings us to another important part of Buffett's investment philosophy, his focus on really understanding the businesses he invests in. He has that famous quote, "Never invest in a business you cannot understand."
So it's not enough to just look at the numbers. You need to understand the story behind the numbers.
Exactly. You need to be able to explain how a company makes money, what its competitive advantages are, and what risks it faces.
It's like being a detective, piecing together all the clues to figure out how the business really works.
Precisely. And it's only when you have that clear understanding of the business that you can make a truly informed decision about whether or not to invest.
All right, so we've talked about moats, capital allocation, and understanding the businesses you invest in. Now let's shift gears again and talk about Buffett's views on risk management. This is an area where he has a particularly insightful perspective.
Yeah, risk management. Buffett, he doesn't view risk as simply the volatility of a stock's price. He sees it as the possibility of permanent loss of capital.
So it's not about the short-term ups and downs. It's about the potential for a business to lose its value, like forever.
Exactly. And he believes the best way to mitigate risk is to invest in companies with strong balance sheets, conservative capital structures, and a history of prudent management.
So he's looking for those businesses that are built to last, those that can weather, those economic storms.
Precisely. And he also stresses this importance of diversification, spreading your investments across different industries, different asset classes. It can help to reduce the impact of those unforeseen events.
Like the old saying, don't put all your eggs in one basket.
Exactly. And by combining a deep understanding of those businesses with a disciplined approach to risk management, investors they can really increase their chances of success in the long run.
Now, I want to touch on something you mentioned earlier, Buffett's his emphasis on ethical behavior in business.
Right. Ethical behavior. This is really a core principle for Buffett. He believes that ethical behavior is not only the right thing to do, but it's also essential for long-term business success.
So it's not just about making money, it's about making money the right way.
Exactly. Buffett, he looks for companies that treat their employees well, treat their customers well, treat their communities with respect. He believes that integrity it's a crucial ingredient in building a sustainable and successful business.
It's like building a house on a solid foundation.
Yeah,
Without integrity, that whole structure, well, it's at risk.
precisely. And that brings us back to that question we posed earlier, what would be different or maybe even the same if you were writing this letter today in 2025?
Ooh, that's a fascinating thought experiment.
Yeah.
On the one hand, I'd imagine a lot of his core principles they would remain the same, wouldn't they? The importance of intrinsic value, of patience, discipline, understanding those businesses you own. Those are timeless concepts.
I agree, but the world is changing so rapidly, and there are definitely new challenges and opportunities out there that would probably shape his thinking.
Like what kind of new risks might he identify? What areas in the market might he find, particularly attractive?
Well, one area that I think would definitely be on his mind is this accelerating pace of technological change. We've seen him embrace companies like Apple, but that landscape, it's constantly evolving, isn't it? Artificial intelligence, biotechnology, renewable energy, these are all fields with the potential to disrupt entire industries.
And given his focus on sustainability, I'd imagine he'd be paying close attention to companies that are developing solutions to address climate change.
Absolutely. He'd be looking for those companies that are both environmentally responsible and financially sound, able to generate profits while also making a positive impact on the world.
So it's like finding those companies that are riding the wave of the future, not just the wave of the moment.
Exactly. And I think he'd also be focused on this increasing complexity of the global economy, things like geopolitical risks, trade wars, cyber attacks. These are all factors that investors really need to be aware of.
So it's not enough to just understand a business. You got to understand the world around it.
Precisely. And that's why it's more important than ever to stay informed, to keep learning, and to be adaptable.
It sounds like the investment landscape is getting more and more challenging.
In some ways, yes. But it's also creating these really exciting new opportunities for those who are willing to do the work and to embrace change.
Well, one thing's for sure, Buffett's insights, they're as valuable today as they ever were. His ability to cut through the noise and focus on the fundamentals, well, it's truly timeless.
Absolutely. And by studying his letters, we can gain this deeper understanding of those principles of sound investing and learn how to apply them to our own portfolios.
So whether you're a seasoned investor or just starting out, there's always something to be gained from the wisdom of Warren Buffett.
Okay, we've covered a lot of ground in this section, haven't we? We talked about market cycles, economic moats, capital allocation, risk management, ethical behavior, and that evolving investment landscape. But there's one more fascinating story from this letter that I want to delve into.
Oh, I'm intrigued. What is it?
It involves a chance encounter, a merger, and a legendary CEO. All right, so imagine this. Sun Valley, Idaho, July 1995. Warren Buffett's leaving a lunch at Herbert Allen's house, and he just happens to bump into Michael Eisner, the CEO of Disney. Wow, talk about being in the right place at the right time. What are the chances?
Right. And get this, Buffett had just seen Eisner give a presentation about Disney that morning, and he was, well, pretty impressed. So he stops to chat with Eisner, just to congratulate him.
I can only imagine the kind of conversations those two would have. Must have been pretty insightful.
Oh, I bet. So as they're talking, the topic of a possible merger between Disney and Cap Cities ABC comes up.
Yeah.
Now, this wasn't, the first time this idea had been thrown around, but those previous attempts, they'd kind of stalled because they couldn't agree on the terms of the deal.
Ah, yes, the classic dilemma. Cash or stock.
Exactly.
Yeah.
But on this particular day in Sun Valley, something shifts. Both Eisner and Tom Murphy, the CEO of Cap Cities, they both signal that they're willing to be a little flexible to find a way to make it work.
I bet Buffett, with his knack for deal making, played a subtle role in kind of nudging them towards a compromise.
Well, I'm sure he did. And within weeks, a deal is struck.
Yeah.
And that deal, it creates one of the biggest media giants in the world. It's pretty amazing how a chance encounter like that can lead to, well, such a huge outcome.
It really does show the power of relationships and just being open to those unexpected opportunities. You just never know where that next conversation might lead you.
And you know what I find really interesting? How much Buffett admires Tom Murphy. He calls him, and I quote, as fine an executive as I have ever seen. He praises his integrity, his focus on shareholders, even his character. It's like he's saying, this is the kind of leader you want to bet on.
That's some high praise coming from someone like Buffett. He's not exactly known for just, throwing compliments around. It makes me wonder, what can we learn from a leader like Murphy? What made him so exceptional in Buffett's eyes?
Well, Buffett highlights a few things like Murphy's long-term vision, his ability to allocate capital wisely, and his just unwavering commitment to building a strong and enduring business. It's like he had that builder mentality, focused on creating something that would really last.
Those are definitely qualities that any investor would want to see in the leadership of a company they're considering. It's a good reminder that strong leadership can make all the difference, especially in the long run.
And here's a bit of irony. Buffett actually admits that a few years earlier, he sold a chunk of Berkshire's Cap City stock. So he kind of missed out on a big part of those gains when Disney acquired them. Even the Oracle of Omaha, he makes mistakes.
It just goes to show you that nobody has a perfect crystal ball. Even Buffett, with all his experience and his wisdom, he can't predict the future with 100% accuracy.
Exactly. It's a humbling reminder that even the best investors get things wrong sometimes. What matters is, learning from those mistakes and staying open to new information.
And I think that's one of the biggest takeaways from this whole story, the importance of staying flexible, adaptable, and open to possibilities. You never know when a chance encounter or a shift in the market might present, a golden opportunity.
Well, I think we've successfully mined all the gold we could from Warren Buffett's 1995 letter. We covered his investment strategy, his views on the market, his thoughts on leadership, even a bit of personal reflection on his own missteps. It's been a fascinating deep dive, and I hope you found it insightful.
It's been a pleasure sharing these insights with you.
And remember, this is just one of many deep dives we have. Be sure to check out our other episodes where we explore a wide range of topics from investing in business to the technology and culture, we're always on the lookout for those hidden gems of knowledge, those ideas that can, well, that can help you think differently and make better decisions. Until next time, keep exploring, keep learning, and keep diving deep.